US markets are mixed after Donald Trump's partial de-escalation of tariffs on China. Investors are looking ahead to US retail sales data tonight. Australian wage growth beats forecasts before jobs data today, while housing lending fell ahead of the Australian election. And in New Zealand, migrant departures hit a new record high. That's coming up in our 5 Things in 5 Minutes on Thursday, May the 15th. And then in our deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, looks at how ASEAN economies and India could use fiscal policy to respond to the economic effects of those US tariffs.
It does seem in the short term there can be a bit of a response, albeit it may not be enough to completely offset the export shock.
But first, in 5 and 5 with ANZ, US markets are mixed ahead of key US retail sales data due tonight, as ANZ's head of G3 Economics, Brian Martin, explains from London.
These data are important because they will give us some insights into how US consumer demand performed during the tariff tantrum that we did have over the past 4 to 5 weeks, and indeed how consumer confidence, which has been down, may be affecting consumer expenditure, despite the fact that the labour market still remains solid.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.1%, the Nasdaq up 0.6%. The yield on the US 10-year bond was up 4 basis points at 4.51%. There are concerns there about the US budget. West Texas Intermediate futures prices fell 0.6% to $63.30 US a barrel. Gold down 2.1% at $3,181 an ounce. The US dollar index was flat, but the Aussie and Kiwi dollars were both weak, down 0.7% to 64.27 US for the Aussie and 58.98 cents for the Kiwi. Number 2. To Australia now, where jobs data later today will provide some of the final pieces of the data jigsaw puzzle before the RBA's rate decision next Tuesday. ANZ economist Aaron Luke is forecasting jobs to grow about 30,000, with the unemployment rate ticking up to 4.2%. That would be the 14th consecutive month, printing within a range of 3.9 to 4.2%.
The ANZ Indeed job ads has pretty much gone sideways since mid-2024. But just over the course of 2025, we think that President Trump's tariffs will have some impact on domestic economic activity, and we might see a slight loosening in the labor market again over the course of 2025. But in the near term, for April at least, the job ads is still elevated, so we think that we're going to see a tight labor market.
Number 3. There were some signs of labour market strength in yesterday's wage data for Australia for the first 3 months of the year. The Q1 wage price index rose 0.9% in the quarter, slightly above forecast and stronger than the 0.7% seen in the December quarter. However, Aaron says the RBA should still be on track to cut rates next week.
We think that it's still broadly in line with RBA's forecast from the Fed statement of monetary policy. There is a lot of data out since RBA's last meeting. The global backdrop has changed quite drastically. Domestic consumption was flat in Q1. Housing lending fell in first quarter. Business conditions deteriorated as well. So I think we can expect RBA to cut 25 basis points next week.
Number 4. Australian housing lending fell 1.6% in the first quarter as the number of approved loans dropped 3.5%. That was below forecasts. ANZ economist Maddie Dunk says the housing market may have got caught up in the rising global economic uncertainty as it fed through into Australian consumer and business confidence.
That could potentially weigh on people thinking about making these bigger purchasing decisions and, of course, also weigh on investor appetite. What we can see in the data for April around sales volumes is that sales volumes were very weak in April. Now, I think that that's partly reflective of that global environment. We also know that typically before an election, the housing market does look a bit softer, so people hold off on either selling homes or buying homes.
Number 5. New Zealand's net migration continued to fall in the year to March to 26,400, the lowest since December of 2022. Departures of just over 123,000 were a new provisional annual record. ANZ senior economist Miles Workman says there are tentative signs the downward cycle has turned a corner, with arrivals trending up across recent months.
Households in New Zealand are perhaps looking for greener pastures offshore, where they may see slightly more opportunity in the labour market. The upshot here is the actual data itself is broadly consistent with our expectation that the migration cycle will gradually turn as labour market conditions in New Zealand begin to improve. But based on our forecasts, that's more of a late 2025 story.
Miles Workman there. Now, in today's deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, analyses the fiscal buffers built up by the ASEAN economies in India and talks to my colleague Alex Tarrant about how long fiscal policy could be used to offset tariff-related downturns.
Prior to the pandemic, Asia's public finances were fairly strong. During the pandemic, owing just to the intensity of the shock and government spending, lower tax revenues, etc., what we saw was a very significant deterioration in budget deficits, and most of all, public debt moved up by anywhere between 10 to 13 points of GDP. And that really constrains Asian governments from responding strongly, more so because they are all on a path of fiscal consolidation. So that sort of truncates their ability to respond to an external shock.
Truncates it, I guess, but how long do you think the buffer they've created versus where they were, how long could that tide these economies over, given what they face with this trade uncertainty?
Yes, so we looked at this issue from both a medium-term perspective and a short-term perspective. And it does seem in the short term, given that growth is significantly below potential and the fact that there is not much of bank lending going on, so there's quite a bit of slack in the banking sector that will allow you to sort of absorb new bond issuances, etc. by governments. It does seem in the short term there can be a bit of a response, albeit it may not be enough to completely offset the export shock.
So what type of fiscal stimulus do you think is most likely or appropriate in this climate, given those timeframes?
Yes. So our view is that it has to be expenditure-based. Reason being that Asia's tax to GDP ratios are generally quite low, particularly when you compare it with the OECD countries. And that means that by reducing tax rates, etc., you don't get the same bang for the buck as you would with an additional dollar of spending. So we really want to see that expenditure levels are stepped up. This could be in the area of welfare. It could be in the area of capital spending. But the problem with capital spending is that it's not that you always have shovel-ready projects to take on.
You have to keep debt servicing costs in mind, obviously, and how uncertain is it there, particularly given the journey that the US dollar has been on in recent weeks?
So I think in the short term, that's where the opportunity is, that the US dollar is much more stable, DXY is at a much more manageable level, and that gives you a degree of latitude to deviate from what the Fed is doing. So you can lower interest rates, and given that banks are not lending very much, I think the impact on bond yields or downward pressure on bond yields will be quite significant, and that should help.
Obviously, all these economies are different, so where might this type of stimulus be more effective?
We felt that it would be most effective in Thailand. The reason being that, one, there is a significant amount of deleveraging taking place in Thailand's banking system. Second, the government has already embarked on various forms of welfare payments and they could potentially step it up. Third, the economy is also operating significantly below potential, but at the same time, Thailand runs a fairly large current account surplus. So you won't get into the twin deficit problem quickly. On the other hand, if you look at Indonesia, even though its budget deficit has been below 3% of GDP. Public debt, at least for the central government, is under 40% of GDP. They have traditionally had a very significant problem with financing of deficits. The moment the government steps up or expands its budget deficit and borrows more, it very quickly feeds through yields. It also results in some sort of concerns by foreign portfolio investors. So it makes financing all the more difficult.
We've obviously had in the last day news of this US-China trade deal, or phase one of it at least. Could that potentially mean policymakers in these economies hold off larger fiscal stimulus packages while they try and see what kind of deals they can get or where the dust will essentially settle in terms of US-China trade?
Absolutely. I think that we will be watchful of two things. One, where exactly do tariffs settle at finally? Because that would sort of tell you whether there's going to be a major recalibration of global supply chains, whether US demand is going to sink. And the other thing is that the US growth by itself has slowed quite a bit. So, and our forecast is that US growth will slow even further. And that's something we have to worry about. But I guess that the tariffs alone or the settlement, as tentative it may be between US and China, it does provide more breathing room for Asian governments.
Sanjay Mathur there talking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, May the 15th. Catch you tomorrow with a look at how Australia's labour market performed during April and what that could mean for the RBA. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.